This is Michael King, and in this video we're going to talk about equity capital markets and initial public offerings. We're going to look at the different sources of financing for a firm, review the types of equity securities and some terminology, discuss why firms go public and the costs and benefits of going public, look at why IPOs are underpriced and then how they perform in the long run, and briefly look at offerings that happen after the company is already listed, either seasoned equity offerings or bought deals. As we've discussed in the capital structure section, firms have different sources of capital. The cheapest is to use cash generated from operations, known as internal funds. They can also borrow either from banks or through trade credit or issuing bonds. Equity will come last in the pecking order. Typically, you might have investment prior to going public from a venture capital firm. That would take the form of either common shares or preferred shares. Now, each of these sources of financing has advantages and disadvantages. For example, young firms with no earnings or assets do not have access to bank debt or to bond markets. Taking capital from venture capitalists will always come with strings attached and involves giving up control and potentially the upside of the business. If we look at the typical sources of financing for a Canadian firm, we see that they require capital to invest in both assets in the form of capital expenditures and net working capital. 2/3 of their capital is typically coming from internal sources in the form of retained earnings and non-cash items. The financial deficit is then made up by issuing debt for 12% and equity for 20%. When going public, a company goes through different stages. It initially begins with a project or an idea, a minimum viable that is used to attract funding, typically from founders, friends, and family, and later from angel investors. As the product is developed and the first clients are signed on, the company will go to a Series A, Series B, or Series C, where they will raise money from venture capitalists who are formal institutional investors that invest on behalf of themselves and other high net worth individuals. Finally, when the company has an operating history, they may be ready to go public. Now in Canada, companies are able to go public at an early stage on the TSX Venture Exchange. But the major exchange, the Toronto Stock Exchange, has restrictions on both the total sales as well as the total assets of a company. Let's look at the different forms of equity securities. Common stock is actual proportional ownership in a firm. As a holder of common stock, you have a right to vote at the annual shareholder meeting. You're represented on the board by the board of directors. There may be several classes of shares outstanding, some with more votes than others. These are known as dual class shares or restricted or non-voting shares. Preferred stock, as the name suggests, has a prior claim on any dividends that are going to be paid out. In exchange for the dividend, the preferred shareholder does not have votes as long as the dividend is paid on the stock. The dividend is typically fixed at the time of issue of the stock, although there are different hybrids that may adjust over time. Warrants are a form of equity option, which are detached and sold separately, which allow the company to pre-sell equity at a fixed price and raise capital. There's a lot of terminology with equity markets. We refer to companies by their ticker symbol, which is a letter symbol assigned to the company when it lists on an exchange. The first time a company lists its shares and makes it available to the public, we call it the initial public offering, or the IPO. Once a company is already listed, subsequent equity sales are known as seasoned equity offerings, or SEOs. A secondary offering refers to a sale of shares by insiders. This sale may take place as part of the IPO or as part of an SEO. A rights issue is when the company goes back to existing shareholders and gives them the right, but not the obligation, to participate in a new sale of shares in order to avoid dilution of their equity stakes. If you don't want to go public, you can always sell shares privately by making a private placement, in which case these unregistered shares are sold to institutions and accredited investors. Finally, when a company buys back its own shares in the public markets, it's known as a share repurchase, and these shares go back into the treasury and are shown as a deduction against common equity. IPOs tend to go through waves, as shown in the figure The blue bars are showing the number of IPOs. You can see spikes in the early 80s, the mid-90s, back in the 2000s, and then sharp drops in periods of recession or following a collapse in the market, following the 1987 stock market crash, the 2000 dot-com bubble, and the 2008 financial crisis. The red line shows the average first-day return on the day when the stock is priced. This is the increase or jump in the stock price on the first day when the shares begin trading. There are a number of benefits, but also costs to going public and listing your shares. The benefits are that it provides access to capital to grow and establishes a value for the firm for the insiders. Insiders can then sell their shares, and by going public, there's greater liquidity and therefore a lower cost of capital for the company. Clients and customers find that having the share listed provides stability because it's a signal about the ability of the company to continue in the future. There's visibility and prestige with ringing that bell on the Wall Street or Bay Street. For shareholders, there are also regulations that will provide greater protection but there are a lot of costs. First of all, the cost of going public can be 5 to 8% of the total offering amount. So for an offering of 100 million, you would be paying 5 to 8 million in the form of underwriting fees and other legal fees. By going public, you are diluting ownership if you sell voting shares, which could lead to a loss of control by the founders and insiders. There are going to be a lot of reporting requirements and a lot of scrutiny from the media as well as from regulators, which could potentially lead to lawsuits if a company is guilty of leaking information or of insider trading. By having shares outstanding, a company is at risk of a takeover. Let's look at some of the terminology and mechanics of an IPO. The process of going public is typically through book building. The underwriters, known as the lead managers, will collect orders from institutional investors and write them down in a book. The lead manager is known as the book runner because they run around collecting these orders in one place. This book is then used to determine the final price. During the week or two prior to pricing, the company will typically conduct a roadshow, which is a series of meetings with investors at different places across the country. The underwriters will have a formal agreement that they sign prior to pricing called an underwriting agreement, which outlines their responsibilities and the fees they will receive, typically 7% for an IPO. Included in that underwriting agreement will be an option to increase the number of shares by 15% if the deal is successful, known as an over-allotment option or informally as a greenshoe. Finally, after the deal is priced, the lead managers will go into the market and buy any shares that are sold in the initial days to try and stabilize the price. On the first day, the average IPO will jump by anywhere from 18 to 19%. The first day returns have varied over different periods, however, as seen in the chart below, where during the dot-com boom, the first day returns were higher than 50%. This underpricing is called money left on the table. What it represents is a transfer of wealth from the inside owners of the company to the initial shareholders. So why does underpricing tend to happen? Well, when a company goes public for the first time, outside investors have access to less information than the insiders who are selling the shares. We call this situation asymmetric information. There is a risk the company is a lemon and that the insiders know it and are selling the shares above their true value to outsiders. For this reason, IPOs are typically underpriced in order to convince investors and take the risk. This underpricing will lead to initial orders that will get the book rolling. Another reason is that their underpricing is a result of a conflict of interest between the investment banks, who are the underwriters, and the issuer. It is in the interest of the underwriters to underprice the shares when selling them to their institutional investors. The institutional investors can make money by the share popping on the first day, and the investment banks will make more money from fees associated with the deal. The clients will also reward the underwriters by buying shares in weak or poor IPOs, and also will provide soft dollar commissions by trading with the underwriters subsequent to pricing. A final behavioral explanation is that entrepreneurs who sell their company are happy to tolerate underpricing if they believe that the shares will go up and their own personal wealth will increase. Keep in mind that most founders are holding shares after the sale goes public, and so they also benefit from the jump in share price. Let's look at the long-run returns for IPOs in the US. From 1980 to 2018, your typical IPO had a return of 22% over the 3 years following the IPO. While this may sound attractive, over this period, if you adjusted for movements in the overall stock market, you would find that these IPOs underperformed the market by 17.5%. If you take into account the size and price-to-book ratios of firms, the underperformance is only minus 6.6%. IPOs tend to underperform, which is why most investors will flip or sell their shares shortly after buying them in the IPO. When a company sells equity following its IPO, we call it a seasoned equity offering. This is the sale of additional equity that is created with the number of shares outstanding increasing. The company must get approval from the board of directors to sell subsequent equity, and the sale in the primary market means that the company will receive the proceeds. The sale of a large block of insider shares is known as a secondary offering. When a company sells shares through an SEO, typically the market reaction is negative, with the share price dropping by 3%. That is because of this asymmetric information. Theories suggest that insiders will sell shares when they believe they are overvalued. This is confirmed by a survey of CFOs where 2/3 agree that the timing of SEOs is determined by the price of the shares. Canadian firms will typically outperform the market by 28% over the year prior to doing an SEO versus 16% for companies in the US. What this means is the company are selling shares after a run-up in their price. These excess returns are then wiped out following the SEO, with both SEOs in Canada and the US underperforming